Hey everyone, I wanted to send this video out or at least post it into the Facebook group. It's something that I do for both my real estate and mortgage team a couple times a week and my coaching clients. But I thought that it would be a big help here for a Facebook group because the number one thing holding back people putting their home on the market is going, hey, I don't want to sell my house and I got to give up my 3% interest rate, right? So what do you say to that, and how do we deal with it? So I want to give you an actual real-life scenario of a real-life client that we have going right now and what we showed them. So let's just roll with that, and then I can walk you through this exactly how it works. So their current home value is worth $585,000. They owe $280,190 on it, but they've got a HELOC for $14,400. Their cost to sell we put in at 6%. And then, so after selling that property, they'll have $255,310 in equity. That's what they wanted to put down on a new house. So what does that look like? Well, before we do that, we've also got to look at their other monthly debt payments. So they have a mortgage payment that obviously will go away when they sell it, of $1,448. They have an $81 a month HELOC payment. They have 3 car loans of $1,486 a month with a $63,000 balance on them. They have credit cards of just under $15,000 with a $445 a month minimum payment. So if you take their monthly obligations all together, it's $3,460. Now, they also owe $92,587 in other debt, right? So I didn't add the mortgage into that. That's just their HELOC, credit cards, and car payments. So they got $93,000 in debt. Well, if they go and buy the $750,000 home that they want to buy, their down payment, instead of taking $255,000, they take $160,000 and they put that down as a down payment on the property. Then they take and pay off all the other credit, the $93,000 in credit, right? So their new loan balance would be $590,000. Closing costs about $12,000. Their new monthly payment, I calculated at 6 3/4, and I did just P&I, not taxes and insurance, because they have the same on their other house. So their new payment would be $3,827 a month on their $750,000 house. So the difference in their monthly cash flow from what they're paying now, right, mortgage payment, all the other debt, it's $360 a month more. So the mortgage payment is $360 a month, more expensive than their lower price. They're like 3 or 3.5% interest rate mortgage they have now, plus all that other debt. So the reality of it is they can get into their $750,000 dream house, and, well, it only goes up $360 a month. But this is where becoming a real estate asset advisor comes in, because, well, we have to look at the difference in the tax deduction they get. So the difference in the monthly mortgage interest tax difference, right? They're paying more in interest because they've got a higher loan balance. And remember, all those credit card, car payments, things like that, that was not tax deductible interest. So the reality of it is, having this higher mortgage payment, they save $523.38 a month in taxes, which means they actually, by selling this house, paying off all that other debt, and buying a more expensive house at a higher interest rate, no question, they actually have an extra $163.38 a month in total cash flow. So they can get the house of their dreams, and they've got an extra $163 a month after the tax break. And remember, as interest rates go down, they'll always be able to take and refinance that loan. Now, there's also other loan programs that we could put them into that, as long as they put 20% down, which in this case they would, we could show them how to get this house paid off in about 8 years with no change to how they live their life right now. So for us, it's really a function of being able to sit down with a potential client and look at the big picture. They really want to move, but, well, they're worried about their 3 or 3.5% interest rate, going, oh my God, I'm going to basically double that. That'll kill me in terms of total cost. Well, the reality of it is, when you simply reallocate the debt, and instead of putting as big of a down payment down, you simply pay off all that other debt. All that other debt was not tax deductible. Their new mortgage is completely tax deductible, and they end up with more cash flow. So this is something that can help you if you break this down and explain it for people when they're thinking about selling, but you hear that answer, oh my gosh, I would never sell and give up my 3 or 3.5% interest rate. You need to look at the big picture for them. So I hope that helps. Hopefully it helps you get some more listings, and for certain to have more conversations. We'll talk to you soon.